Haters gonna hate. When the industry's really out of favor in the Wall Street fashion show, and I mean just totally despised beyond all reason, the haters will never let the facts get in the way of their preferred negative story. Right now, we're seeing a textbook example in the home builders. The conventional wisdom here says that the housing business is a dead man walking. Between rising interest rates and higher commodity prices for things like lumber, steel, aluminum, every home builder is supposed to be in big trouble. And hey, I get it. The hedge fund playbook says you need to sell these stocks when the Fed is tightening. But there's just one problem with the thesis. The home builders refuse to play ball. We keep hearing that they're roadkill, but they keep reporting phenomenal numbers. Take Toll Brothers, the huge luxury home builder. When Toll reported 3 weeks ago, it shot the lights out, delivering a monster 23% earnings beat off of a $1.03 basis with higher than expected sales, up 27% year over year. The quarter was so magnificent that the hated stock popped 13% on the news. But most investors simply do not believe Toll can keep delivering. That's why the stock has given back about half those gains as the bearish narrative has reasserted itself. At these levels, Toll's down an astounding 24% for the year, trading just 8 times earnings. Insanely cheap valuation, unless you genuinely believe that the estimates are way too high, meaning Toll won't be able to make the numbers. However, if Toll can simply hit its own forecast, the future looks so bright. Can they? Let's go straight to the horse's mouth with Doug Yearley, the CEO of Toll Brothers, get a better read on the general state of the housing market and on Toll itself. Mr. Yearley, welcome back to Mad Money. Good to see you, Doug. How have you been? Have a seat.
Doing great.
All right, Doug.
Thanks for having me.
I have to admit, I'm confused. You've got record third quarter contracts. Millennials are coming back in the market. People have wealth in their existing home. We have an amazing employment pattern. Tell me what I'm missing.
You're not missing anything, except you didn't mention consumer confidence, right, which is the fourth prong there, right, which is also very high. So we're doing great. We love our niche. The luxury end of the market, right, is very strong. There's more and more households that make $100,000 or more, which is our business. Our loan-to-value ratio of our buyers, 67%. It's down. It's down from where it used to be.
You put that all morning. I heard that bad lending's coming back, and I look at your numbers. It's just the opposite. What did you have? 23% of people paying cash?
It's been 20%, and it just jumped up to 25%.
It's unbelievable.
It was 70% LTV. It's now down to 67%. Right. Mortgage rates, they are lower today than they were 4 months ago.
The commodity cost, you've got under control. Lumber's down big.
And in the last 7 months, mortgage rates are only up 1/8 of 1%. We're still sub 5.
Right.
It's a great rate. Millennials are coming out. Now we know they're marrying later, so they're buying homes later. Right. But that also means they're wealthier when they buy, which means some of them will be able to afford our homes. If not, they're going to buy the homes from our buyers because, right, we're obviously, while we're not selling the starter home that's in our food chain, we need that to be healthy. And there's just not an overhang of supply. We're not over-speccing in the industry.
We're not overbuilding at all. We're still well under, right? We're well under. It's still a housing shortage, but you guys happen to have the right land.
Main and Main. That's what we do. We buy land at the corner of Main and Main. That's been our business. We tend to compete against the local builder. They're not nearly as well capitalized as we are, so we have an advantage in the land buying. We have a great brand. And we have a great, national geographic footprint. So I'm very happy with the business.
But you are very transparent in all your numbers. You always has been since I first met you. You said that California's gotten a little soft, and you said the very expensive properties in New York City are not moving as well. It's almost as if people are letting those control. How little a part of the whole mosaic are those two areas?
So California is an important market for us. Right. We have about 25% of our business out in California. It was a strategic move to move west over the last 5 to 10 years. California is not as hot as it was last summer. It's still one of our top markets. Last summer was very odd in that we sold more homes in the summer in California than in the spring. Right. And everybody that follows the industry knows that the spring season is when most homes are sold. So when you look back to 2006, if you look back 2 years ago, our numbers are up significantly. It was just last year was an aberration. But the California market is still doing very well. We have terrific locations. So I'm thrilled with our California operation. And I think looking forward, it's in great shape. Well, in New York, you mentioned?
Yes.
Some of the very expensive units in New York City have certainly slowed. Right. We have refocused on the $2,000 a square foot and less locations and price point, which also means smaller units. And Hoboken and Jersey City, which are now at $1,000 off the water and $1,400 waterfront, they're outperforming what we ever expected.
Now, I would not be as bullish if it weren't for the fact that you are as bullish, as demonstrated by your buyback. I remember years and years and years, you never bought back any stock, but you're in there almost every day.
So year to date, we're about 9.5 months in, 10.5 months in. We have bought back over $400 million of our stock, which is about 7% plus or minus of our outstanding shares.
And price to book, have I ever seen it this low?
We're 1.1 times book, and we're trading at 8 times consensus EPS.
Well, I mean, I remember when KB Homes was that, and I said it was going to double and it triple. I mean, it's just not right. There's something wrong here. I guess that's my view. It drives me crazy. When you reported that quarter and Bob was on the call and I just said, okay, here it is. We're done going down. And it didn't happen. And I'm very proud of you guys because, you know, I'm Philadelphian. And
yes.
I still don't get it, but one day it'll come back.
We just keep doing what we're doing, which is grow, buy land in the best locations, make really smart decisions, build this great brand. We're so proud of our brand.
It's very high listed on the Fortune, on that incredible list.
We are.
Top 10.
Top 10 most admired brand in the world.
Right.
And you know what's, this is the largest premium for a new home to a used home that I've seen in my 28 years. And it's because the architecture's better, the options you can put into the home are better. More and more people want new than ever before, and we're really benefiting from that.
Well, I'm going with you. That's Doug Yearley, CEO of Toll Brothers TOL. The stock is down almost 25%. Some of these things just aren't making any sense to me. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.